this is the most difficult time for running client money. Political risk is off the scale in terms of the complexities it creates for us as analysts and asset managers. So we constantly look at the outcomes. We use some, I always think very important to look with your eyes, listen with your ears to what's happening on the market on a day-by-day basis. But alongside that, we use some quite sophisticated models which can create stresses of different things happening. So we were running a double stress test coming up to the referendum. One was Brexit limited contagion, one was Brexit with wider contagion. We knew there would be short-term hits to asset prices in Brexit either way, and it happened. We covered that off because we believed the dollar would be safer and would rise in value against the pound, and on the Friday that the referendum happened, our portfolios went up in value. That was great. So we're keen to try and engage the next risks coming up with strategies that can help get our clients' assets through them. But whilst we're doing all that, we've got to be mindful of the fact that what if the world navigates its way through these problems well? What if new inventions and productivity suddenly starts to kick in again? And you've got hundreds of years of evidence showing that mankind is an extraordinarily innovative race that will keep creating new tools and new services in an ever-improving fashion. What if all this happens? And what if then share prices go up a lot? If we're overly cautious, we miss the rise. If we're overly optimistic, we get hit by the downs. But that's what running money is all about. In the end, when it's times like this, you don't take big bets. You diversify as much as you possibly can. You cover off wherever and whenever you can, and you keep the portfolio so that it will benefit from rising prices. And that is what we'll be doing for the rest of the summer.